Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Senior Currency Analyst at MUFG. It's Friday, 28th November 2025, and joining Lee to pose some questions on the financial market themes for the week ahead is Seiko Kataoka-Fisher, Director from Japanese Customer Sales for EMEA in London. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hi, Lee.
Hi, Seiko.
What currencies have been the biggest move over the past holiday shortened week?
Yeah, we've seen the dollar correcting lower this week on the back of the US rate market moving to price in another rate cut from the Fed in December. That's been encouraged by the comments at the end of last week from New York Fed President Williams, who signaled that he still sees room for another rate cut. Obviously, as a kind of key member of the leadership team at the Fed, that is sending a kind of stronger signal that the Fed will look to try and push through at least one more rate cut. And that's been supported as well over the past week by some softer data releases from the US. It looks certainly more likely now that core inflation will undershoot the Fed's year-end forecast, which at the margin could certainly put more pressure on the Fed to cut rates again in December as well. While the dollar's weakened, we've seen other currencies obviously strengthening. The biggest kind of beneficiaries this week have been the more kind of high beta commodity related currencies, such as the New Zealand and Australian dollars. They've been supported by the improvement we've seen in risk sentiment, and at the same time, a hawkish repricing of expectations for RBNZ and RBA policy going forward. We had the RBNZ meeting earlier this week, and while they lowered the policy rate again by 25 basis points to 2.25%, the updated guidance did signal more strongly that that was likely the end of the rate cut cycle, which has helped to boost the Kiwi. And in Australia, we did see as well the release of more evidence of stronger inflation, which alongside the recent tightness we've seen in the labour market there is making it more and more likely that the RBA will keep rates on hold for longer going into next year as well. And then finally, the kind of other currency which has kind of benefited or outperformed this week has been the pound amongst major currencies. We saw a relief rally after the budget yesterday, which to us kind of mainly probably reflects some lightening up of short pound positions, which had kind of been built up ahead of the budget announcement. And yesterday, the budget wasn't sufficient to trigger a sell-off in the gilt market, so there was no need to keep such large short pound positions heading into year end. Having said that, though, we still feel that this rebound for the pound is unlikely to be sustainable. The focus will quickly shift back to the upcoming Bank of England meeting in December, when we expect the Bank of England to resume cutting rates again, and that should keep downward pressure on short-term yields in the UK and the pound. We also think as well that the initial kind of relief over the budget, we don't think that's going to last. Certainly, if you look at the details of the budget, while there were no kind of nasty surprises to destabilize the gilt market, we would still say that the government did choose to increase taxes so that they can spend more on welfare. And we think those policy choices, there's still doubts over the credibility of the commitments to higher taxes. As we know, a lot of those tax hikes have been planned for further into the future, closer to the next election. So it's certainly questionable to what extent the government will follow through with those tax hikes. And additionally, obviously, a lot of those tax hikes as well will be on savings, and also making it more expensive for businesses to employ workers. So for us, that's a negative development for the growth outlook for the UK as well. So all in all, we don't think the kind of short-term relief rally for the pound will be sustained.
The Japanese yen has continued to weaken alongside the US dollar this week. What could change the weakening trend?
Yeah, similar to other dollar crosses, dollar yen sort of peaked late last week at around 157.89. And this week it's failed to kind of advance further to the upside. Obviously, in part, that reflects the dovish repricing of Fed rate cut expectations and the broader kind of weaker dollar that we've seen this week. But in Japan as well, we do think that there is also some element there of investors becoming a bit more comfortable over the Japanese government's fiscal plans. Obviously, we've now seen the release of the details for the Japanese government's extra budget, and that has helped to provide some comfort to investors. Obviously, the size of the fiscal spending plan will total 18.3 trillion yen. There had been some fears that could have increased to over 20 trillion yen. So it does look like perhaps there had been some potential pushback there from the MOF to try and control the size of the spending package in Japan. And we've also had as well the release of the details of the funding package to finance that budget. And we did find out that the government will be issuing 11.7 trillion of additional debt to fund the budget, of which 6.3 trillion is expected to be in the form of short-term bills. So obviously the government there is obviously trying to skew the debt issuance towards the short end of the curve to try and reduce selling pressure at the longer end of the curve. So that is, I think, helping the JGB market at the longer end to stabilize over the past week. And I think that kind of stabilization there at the longer end of the curve has helped to ease some of the yen selling pressure this week. We do think going forward that going into year end, the focus will probably shift back more towards the outlook for monetary policy in Japan. So with the BOJ's next meeting coming in December. Over the last week or two, we have had some more hawkish comments from BOJ officials, including Governor Ueda, who indicated that he'd be watching more closely the potential inflationary impact from the weak yen. In light of those kind of more hawkish comments and the yen weakness that we've seen recently, our colleagues in Tokyo have decided to bring forward their forecast for the timing of the next BOJ rate hike to December from January. And we think that if the BOJ does hike rates earlier in December, then that would be certainly more effective in reversing the yen weakening trend that's been in place recently than just, say, intervention on its own. I think if they just intervened and the BOJ left rates on hold, then I don't think that would be enough really to reverse this weakening trend for the yen.
Thank you very much, Lee.
Thank you.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe. Contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.